From an Indian equity perspective, if investors, viewers watching this right now want to Trump-proof themselves or make themselves safer from global tariff headwinds, does it make sense right now to focus on domestic plays, avoid export-oriented businesses or businesses which have more exposure, auto, pharma, and the like, and focus, say, perhaps on financials or more domestic stories?
So that has been the one of the themes which we are recommending to investors, that coming 2, 3, or 4 years perspective, if global demand does not pick up materially or slow down is a reality which we are entering into, then in that scenario, domestics will tend to do well over exporters. We have seen since COVID, exporters have been outperforming domestic demand, which clear being evidence where financials and consumers were sufferer over the last 3 to 4 year perspective. But now table is turning, where you are having a global trade uncertainty. On the same point of time, the policymaker in India are trying to revive the domestic demand, which most of the heavy burden being shared by monetary policy or the regulatory policy easing happening from RBI. With that being the case, the only way to safeguard your portfolio is don't buy anything in terms of an equity exposure which has 10% or more revenue exposure to US. That means you will totally be avoiding any kind of an export exposure over here. And what you can actually buy is having 90% or more exposure to domestic demand. That's where your financials, consumer staples, discretionary ex auto, power, cement, and hospital, along with defense, fits the bill.
Interesting, and very, very, insightful take there. I mean, conversely, IT, pharma, all of those become more and more risky apart from other export-oriented businesses, especially with US exposure is a point that is being made. Thank you so much, Rajiv, for speaking with us. Always a pleasure to have you on NDTV Profit.
Thanks, Amanda.